Good afternoon, and thank you for joining us for a virtual alumni workshop on understanding student loan debt and strategies for paying them off more efficiently. Before we begin, we are going to take a moment here to pause so that everyone has the chance to log on. While we wait, feel free to type your name, grad year if you're an alum of UMD, and what brought you here today in the chat box, and we will begin in just a moment. Well, my name is Molly Clevin, and I'm from the University of Minnesota Duluth Alumni Relations team. In today's Alumni Career Workshop, you will learn about various student loan repayment plans and strategies for paying them off. Today's session is in a webinar format, meaning you have the ability to engage using the chat box and the Q&A. If you have a question for our presenter, please use the Q&A button on the bottom of your screen. I'd also like to note that personal or financial questions are unable to be answered during this session, but Vince has agreed to set aside time in the following days for one-on-one 15-minute appointments. And we'll be sending a link out following the session for you to sign up. So again, the Q&A portion of this webinar is definitely more general. So now to introduce our guests. Today we are joined by UMD alum and Bulldogs of the Last Decade member, Vince Darling. Vince has been in the financial service industry since 2018 and became a certified financial planner certificate in 2022. He graduated from UMD in 2019 and went on to work with the Stonebridge Group as a financial advisor. He specializes in comprehensive financial planning, investment management, tax planning, and student loan planning. In his spare time, Vince often travels back to Duluth with his fiancée, Sadie, who is also a UMD alum, enjoys golfing, water skiing, mountain biking, and of course, being a Bulldog. So now it's my pleasure to hand it over to Vince.
Awesome. Thanks, Molly. Appreciate the kind introduction, and I appreciate everyone for joining today. We're going to try to cover a lot in a short amount of time. As Molly mentioned, this is all about student loan debt. Student loan debt has kind of been in the news a lot lately. Biden's forgiveness program, the new SAVE plan. There's been a lot of new things that have been circulating in the student loan world. So I thought it was fitting to kind of give some education around what all this means. What are some strategies to think about paying off your own debt? So the agenda today, really wanted to go over, a student loan update, what's new, what's happening, private loans versus federal loans. We're going to talk about the difference between PSLF and the IDR 20-year, 25-year forgiveness program. The income-driven repayment options, the difference between consolidating and refinancing your student loans. That tends to be a big one. People don't quite understand the difference or use the words interchangeably. Biden's IDR waiver that expires at the end of the year this year. And we're going to talk about different planning strategies to think about when we're paying back your student loans. Lastly, I'm going to end with a case study, just how proper planning has the ability to, save people money possibly when planning accordingly with their student loans. Just want to make a disclaimer here, this presentation is for really educational and informational purposes only. I do not consider this advice at all. I don't know your personal situation. Please consult with a financial advisor of your own, tax consultant, advisor, legal advisor, any professional before making any kind of decisions regarding your personal situation. So first off, what's new in the news? The student loan pause is coming to an end. We've had the last 3 years where we just haven't really had to pay on any federal student loans because of the COVID pause. So starting at the end of August, so September 1, interest is going to start accruing on your loans once again. October 1st, your first payment is going to be due. What is stuff you should be doing right now? You should really be logging into your loan servicer's website, updating any personal information, address, phone number, maybe a checking account. Maybe you had, automatic payments taken out of there. Maybe you no longer have that bank account. Make sure that's getting all updated for you. Look to see what your scheduled payment will be. Sometimes they give you an estimate of what it's going to be when you start back up. And then make any changes to your payment to help with your goals on repayment. So maybe that's changing to a new IDR plan. Maybe it's keeping it to where it's at. Maybe it's now you work for the public service. We're going to go over all these different kind of scenarios as we go through today's webinar. Probably the biggest thing in the news is the new IDR plan, Save Repayment Plan. You might have actually gotten a letter in the mail saying, hey, check out this new Save plan. On July 1st of 2024, the new Save, or Saving for a Valuable Education plan, will be in full effect. Other IDR plans are being phased out, including Pay and Repay. Repay is being phased out by actually turning into Save. So if you're on the Repay IDR plan, it's actually going to be called Save from now on. And Pay is another one that is soon going to be phased out of a possibility to choose from. So with the Save plan, they're increasing the federal poverty level from 150 to 225, while also using 5% of your discretionary income instead of 10%. What does this really all mean? Really means it's taking less of your income to calculate your payment, probably resulting in a lower payment, but not for everyone. And we'll go into, for that reason why, into the webinar here. And then they're also talking about student loans with the original balance of under $12,000 will be forgiven in a 10-year period. I think that's still in the works because when you calculate payments, sometimes you end up paying it off anyway. So there's not really anything to be forgiven. So just keep that in mind as well. So those are kind of the updates, what's happening in the plan. These are the type of loans, do you have? So we have, basic two kinds of loans, federal loans and private loans. All right. So first we're going to jump into the federal loan system. Federal loans have a whole list of different ones that you might have gotten depending when you graduated college. Direct loans, subsidized, unsubsidized, consolidation loans, maybe a plus loan. If you were taking loans out before 2010, you might have something called an FFEL loan or a federal family education loan. There's also other loans, including Perkins loans, loans of disadvantaged students, primary care loans. Those are not as common, but they're still out there. Then there's the private sector. Really all that means is a bank owns your loans. You didn't get it through the federal system, not the Department of Ed. It's actually through a bank. Okay, there's going to be less options with those, and we'll kind of go through what you can do with a private loan as well. So talking about the difference, so a federal loan, direct subsidized loans or direct unsubsidized loans. So you probably see it both on your statement when you have your list of 6 or 7 different loans that you've taken out. So really when we're looking at direct subsidized loans, it's pretty much they're covering the interest while you're in school. Okay, so your interest isn't capitalizing within your loan while you're in school. When we look on the unsubsidized loan, while you're in school, because it's not subsidized, you are actually accruing interest while you're in school. That's the basic two difference, or the main difference between the two. So what are some, federal loan, federal perks that you have? Well, let's talk about the biggest one. For the last 3 years, you haven't had to make any payments. So when we look at that, that's kind of huge. When we're looking at, hey, we didn't have to make any payments 3 years and 0 interest in that time frame. So that was one of the perks. If you had a private loan or a commercially held loan, you didn't get that benefit. Pause of student loan repayments that I just talked about, possible forgiveness in the future. That means you're able to go for those forgiveness programs that are available. You have access to income-driven repayment plans, which is based off your income, and you have the chance for forbearance during that time as well. So these are all things that really aren't associated in the private sector. Federal loans, pretty much you start with a 10-year repayment. So if you don't do anything and you have to repay your loans, it's a 10-year repayment schedule. They calculate your loan for 10 years. That's how they calculate the payment. Those are balance-based repay options in the federal loans. Okay, you can also use a graduated schedule, increase the loan amount to 25 or 30 years. Not all loans are able to do that. You have to go and kind of check that out. And then the biggest one is the income-driven repayment loan. So these payments are based on your borrower's income and family size. So for example, if you're leaving school and you didn't get a high-paying job, maybe an IDR plan is a good place to start to keep your payments low, because on the 10-year track, maybe the payment's just too high for you at this time. So this is where kind of those income-driven repayment plans come in. Income-driven repayment plans also give you the ability to go for forgiveness, which we'll talk more in detail as well. All right, so when we're talking about income-driven repayment plans, what we're talking about is the payment plans that take your income and your family size. Okay, that's how they calculate the payment. So sometimes you can have payments as low as $0. Sometimes they can go as high as $300, $400, $500, $600. It really depends on your income and your family size. So I want to just go over some of the changes that has happened in this space. So there have been several different repayment schedules when it comes to the income-driven repayment plans. So there's the income-based repayment plan, or IDR, pay-as-you-earn repayment plan, or the pay plan, which is going away, like I said at the beginning. The revised pay-as-you-earn repayment plan, or the repay plan. If you're on the repay plan, you're going to be moved to the save plan. If at a later date, if you don't have the repay option, that's because now your only option to choose from is going to be save. Okay. Also, the income contingent repayment plan is actually going away as well. So when we're looking at loan forgiveness, income-driven repayment plans usually result in a lower payment, which allows you to get the most forgiven on either a 10-year schedule or a 20 to 25-year schedule. And we'll explain the differences between those two, because I know forgiveness can be very confusing. Also, with these IDR plans, keep in mind, you have to recertify your income every year because they need to know what you're making to calculate your payment. And sometimes if you don't recertify your income, they can actually kick you off the plan. All right, so really, that was all federal loans. So those are all the options and different things associated with federal loans. We're now on the private student loans. So like I said, there's two, federal and private. We're now on the private. Private loans are made through a private lender, like a bank. There is no access to IDR plans. So you can't go on and say, hey, my income's this much, I can't make the payment. They don't care at that point. You can possibly lower your payment by refinancing either to a different bank, or you can increase your loan, the amount of years that you have to pay it off. So your term length. So maybe you're on a 10-year, maybe you can change it to a 20-year. They have to all approve this. So sometimes you could get denied as well. There's no federal perks. You didn't get the forbearance for the last 3 years. You can't just stop making payments. They don't play those games. So there's no reason to try to do that. But sometimes you can call, maybe they'll negotiate something with you. It has been done, but it's less possible than on the federal system. All right, so we talked about the different types of loans, federal and private loans. Now we're going to talk about, what is the difference between this consolidation and refinancing? You hear these words in the news all the time. Sometimes they use them at, interchangeably. What do they actually mean? What's the difference between the two? So we're talking about consolidation. Consolidation just has to do with federal loans, okay? Nothing has to do with private loans. A consolidation is where you take your federal loans. If offered by the government, you combine your federal loans together. So what that means is, let's say you have 7 different federal loans. What you do is do a consolidation, take those 7 loans, put them into one loan, into a direct consolidation loan. It doesn't change the interest. So what they do is they take the interest on all those different loans, take a weighted average, and that's your new interest rate. So you're not saving any money through interest. What it can be a benefit is if you're making different payments on all those different loans, now you just have one payment to make on all those loans, and you can possibly lower your monthly payment because you might be able to lengthen the term by doing a consolidation or moving to an income-driven repayment plan. Okay, so consolidation, only federal, not private. Refinancing. Okay, refinancing is moving into the private sector, okay? So you refinance to help reduce your interest. This was a big thing back in 2020, 2021 when interest rates were low. People were paying 5, 6, 7, 8% on their federal loans. and they wanted to move it to a private loan where they only had to pay about, sometimes 2% on their loans. So they did what's called a refinance. They took it out of the federal system and moved it into the private sector. Okay. They do this for many reasons. One is to lower your monthly payment. It lowers your monthly payment because you have a lower interest rate. You can shorten your loan term to pay off your debt sooner. Okay. So you don't have to pay as much in interest while you're paying off the loan. And you can reduce money you spend on interest. Like I just mentioned, because you're moving from a 7% to a 2% interest rate, you're paying less in interest. Okay, what are some downfalls of doing this? Some downfalls is by taking money out of the federal system into the private system, we now lose federal perks, no more, forbearance or deferment. You lose all those. You no longer have access to an income-driven repayment plan based off your income, okay? And you can't apply for public service loan forgiveness or a 20 or 25-year forgiveness plan. Okay, so those forgiveness options no longer apply. Refinancing, you can also do with a private loan. So if you take one private loan from one bank and refinance it with another bank, sometimes you can get a lower interest rate. So you can also refinance going from private to private. So like I mentioned, consolidation, federal to federal. Refinancing is federal to private or private to private. Okay, that's the difference between the two. All right, so now we're going to go into, what is all this forgiveness all about? It doesn't make much sense. It seems like they're always changing rules, and that is the case with student loans. They seem to always be changing different rules all the time, so it's hard to keep them straight. So this is the rules as of today. All right. I want to first, before we hop into public service loan forgiveness, I want everyone to realize that when the Biden administration came out with the 10,000 or 20,000 year forgiveness, this has nothing to do with these forgiveness programs. That was something completely separate. It was struck down by the Supreme Court. So it's no longer a possibility to, he was going to cancel 10,000 or 20,000 of your student loans. And because it didn't go through the courts, it ended up not happening. But these ones that I'm going to talk about are still active. So these are still ways to get forgiveness, just not through that plan. So jumping into public service loan forgiveness. This is a way to get your loans forgiven after a 10-year period. So this is normally for people working in the public sector, teachers, nurses, doctors, police officers, firefighters, maybe some lawyers that are working in the public sector. So really, how do you qualify for public service loan forgiveness? There's pretty much 4 rules you have to abide by in order to get your loans forgiven. So first is the employment. You work for a public service organization. There's on studentaid.gov, you can go in there, type in your EIN number that you can find on your W-2 that you get at the end of the year. Type it in and it'll let you know if it's eligible or not. Okay. You have to be working at that public service organization for 30 hours per week. That's considered full-time employment. Okay. So if you satisfy that, you satisfy the employment, we move on to the loan. Direct loans, it has to be a direct loan or other federal loan that are consolidated to a direct loan. Okay. So they don't count FFEL loans. That tends to be the biggest one that people think is counted, but they actually don't use that type of loan. The payment plan, you have to be on an income-driven repayment plan in order to qualify for this. So that includes the IDR, the pay, which is going away, the repay, which is turning to the save plan. Okay, you have to be on one of those income-driven repayment plans. When it comes, it says it's possible you can also be on the 10-year standard plan, but if you pay your loans off in 10 years, there's really not going to be any forgiveness at that point anyway, because you have to be in it for 10 years. But during the COVID pause, there's 3 years of payments that should count that you didn't have to make payments. So really, it's just 7 years left. The only issue is when you read on the studentaid.gov website, there's parts that say, yes, you can be on a 10-year standard plan. And then there's parts that say, no, you have to be on an income-driven repayment plan. So this is something you have to talk with your loan servicer about before making any kind of decision if moving to an IDR plan, or if it makes sense to stay on your 10-year standard plan. The last part is your payment. So it's 120 on-time, full scheduled monthly payments. So what does this mean? For 10 years, every month you have to make a payment. And after those 10 years, if you're working for a public employer, you had direct loans, you're in an IDR plan, and you made those 120 payments, whatever's left over is now forgiven at that point, okay? In a tax-free atmosphere, so you don't have to pay taxes on it. That's public service loan forgiveness, okay? Now there's the IDR 20 or 25 year forgiveness program. This is the second largest forgiveness program. For this forgiveness, you do not need to work in the public sector. So you don't need to work for, be a doctor that works in, a public hospital. You can, work in the private sector. After paying on an income-driven repayment plan for 20 or 25 years, the remaining loan balance is going to be forgiven. This is considered taxable, could create a tax situation. So where I mentioned that public service loan forgiveness is not taxable, right now the IDR plan is considered taxable. So it would be added to your income and you would have to pay the taxes on whatever is forgiven. Forgiveness of 20-25 years depends on the type of repayment plan you are on. So sometimes, if you're on the pay plan, it's going to be different than if you're on the save plan or the IDR plan. And it needs to be a direct loan, once again, okay? So big difference between this and PSLF is you don't have to work in the public sector. Instead of 10 years, it's 20 or 25 years, okay? And this is considered a taxable event where the public service loan forgiveness is not. Other forgiveness programs out there that I highly recommend people kind of take a look at. Don't forget to look for programs available for your certain occupations. For instance, there's a teacher loan forgiveness program, which if you work for I think it's called a Title I school, you can get some forgiveness that way. Nurse Corps loan repayment programs out there. There's another Students to Service loan repayment program that's out there. These are all for, nurses working in highly needed areas. And, even on your state level, definitely worth taking a look at. Minnesota Healthcare Loan Forgiveness Program is an option that's out there for nurses as well. So look at your state level as well to see if there's any forgiveness programs. So one of the biggest things that's still kind of humming around in the student loan space is what's called the IDR waiver. So the IDR waiver is under the Biden administration, pretty much trying to fix things that didn't work out for the past years. People were kicked off different IDR plans, have been paying their loans for 20 or 25 years and still no forgiveness. So this is like their way of trying to recalculate those payments. People with older FFEL loans or Perkins loans might benefit from this. And I'll give kind of an example of kind of what I mean by that. So like I said, it's a one-time account adjustment by the Department of Education. For most people, you don't have to do anything. They're doing this in the background, okay? All borrowers can now receive credit toward IDR forgiveness for any time between the 20 or 25 year forgiveness program. Here's the catch. The deadline is December 31st, 2023. So what doesn't count is, let's say you still have a commercially held FFEL loan. That's not going to be counted as your IDR forgiveness because it's not a direct loan. They're only calculating through the direct loan system. So this is where a great opportunity could be for borrowers with commercially held FFEL loans or Perkins loans to possibly consolidate. And here's an example. Let's say you had, a Stafford subsidized loan with 50 payments, but you also had another FFEL loan with 200 payments. By what they say on the rules on the website right now is if you consolidate those two loans together and they have overlapping payment histories into one direct consolidation loan, that loan would take the higher of the two. So in that case, you could put both those loans together and you get 200 payments that would be calculated towards the 240 or 300 for that 20 or 25 year forgiveness program. If this is something that you want to do, they're only doing this one time, so it has to be done before the end of the year, December 31st, 2023. Now, please note, this can be a great opportunity for many people, but it's not for everyone. For instance, if you consolidate, you could possibly increase your payment. You haven't had to certify your income on some of these income-driven repayment plans for the last 3 years. What if your income has risen substantially in those 3 years? Now you're forcing yourself to recertify your income, causing a higher payment, and actually might not be a benefit at all. So it's definitely worth looking into, see if it could possibly help you. But remember, this IDR waiver isn't for everyone. So now we're going to talk about just kind of when we're looking at student loan repayment strategies, what are some things we can, ask ourselves some questions to do to try to pay these off? So in my mind, I think of it as two main questions to ask. Do I have private or federal loans? Or do I work for a qualifying public service position or do I not? Okay. So if you have a private loan, pretty much your only option with that private loan is to refinance to a lower interest rate. In today's environment, you might actually not get a lower interest rate because interest rates have gone up so much. That's pretty much your only options with these private loans. As far as the federal system, that's when you have to ask, do you work for a public service or do you not? If you do work for a public service, your goal is to make your payment as small as possible. So in 10 years, you're able to get the most forgiven. So what are some things to think about? Ask yourself, does it make sense if I have a large balance and my spouse doesn't? Should we be filing separately? Is that beneficial? Is it not? Because we lose some tax benefits from doing that. Look for ways to increase your forgiveness amount through maybe putting money into your retirement accounts, traditional IRAs, 401ks. By putting money in there, you're reducing your income, which reduces your payment. So that's ways you can help lower your payment during those 10 years as well. Do you prefer a payment cap? I mentioned that because through the SAVE plan, your payments don't have a cap, so they can go as high as your income keeps going up. Okay. Through the pay plan, your payment is capped at that 10-year level. So it can start out low and then hit that max 10-year level, and then it won't go up any higher than that. So that's something to keep in mind when you have to decide which IDR plan to go on. If you're not pursuing PSLF, does it make sense to refinance, get out of the federal loan system to possibly save some money? Are you trying to pay it down as quickly as possible? Or are you just trying to make a low monthly payment right now because your income's not that high and your current monthly payment is too high to withstand at this point? You're going to have to pay more interest in the long haul, but it's better than defaulting on the loan. So that's all some questions you have to ask if you're working in the public sector. If you're not working in the private sector, okay, you prefer lower payments. If you prefer lower payments, you're looking for an income-driven repayment plan. Even though you're not going for PSLF, there's a chance you could still get the IDR forgiveness on that 20 or 25 year. All right. If your main goal is to pay them off as fast as possible, like I said, refinance to a private loan, possibly has a lower rate. Just remember, you can't go back to the federal system. Or, try a snowball approach with these debts. Maybe you had a car that you just paid off. You're making a $300 payment. Take that $300 payment, make extra payments on your student loans to try to get them paid off. And then always ask yourself, will I ever go back to the public sector? Because if let's say you move to a private loan and then you end up working in the public sector, well, you can't get on that PSLF system anymore. Okay. So that's kind of some questions to ask yourself when you're going through these different ideas of how am I going to pay this off? What's the best strategy? Start asking yourself those questions. It can, help lead to possible answers for you. Lastly, just going to go over a case study here. This is just a hypothetical, but can show you how proper planning can actually end up saving you possibly some money. For instance, this is Mary and John. Let's say Mary graduated, has a graduate degree in nursing, works at a public hospital, was in school for a long time, has almost over $300,000 in federal direct loans. Her interest rate is 6% average on those loans. If she were to stay on the 10-year standard repayment, she would have to make a payment of $3,442 a month. Okay. Her income $60,000 and her husband John's income is $52,000. Okay. Put those incomes together, $3,400 a month for a student loan payment is not going to be easy. They both have access to 403Bs, and Mary plans on staying in the public sector. Does it make more sense to pursue PSLF or refinance? Okay. So let's talk about if we were to go the public service loan forgiveness route. Okay. Since Mary has direct federal student loans and works at a qualifying hospital, she can go on an IDR plan. Using the SAVE plan, let's say she moved to the SAVE plan, her monthly payment would change to $395 a month. That's $3,047 a month less than if she was on the standard 10-year. Let's say, you get raises throughout the year. Her income still increases 3% a year. Mary's monthly payment will go up slightly based off that. After 120 payments or 10 years, Mary would have to pay $54,271 over those 10 years. The remaining balance of $401,000, which was capitalized from the interest over that time, would be forgiven tax-free through the PSLF system. Okay, so she saved almost $400,000 just going through that system. Now, let's say she wasn't aware of PSLF, and someone told her, it's best to refinance because rates are low, or you can get a lower interest rate. If she did this route, this is what it would look like. She refinances her interest rate from, let's say, 6 to 4%. So she's saving 2% on interest. It reduces her payment by about $300, moving to $3,139 a month. For that 10 years, she has the loan paid off, but she would have paid $376,632 in total payments she would have made. Okay. That's a lot more than the $54,000 she would have paid pursuing PSLF. So you take those two, subtract them. Now we have $322,000 that she would have saved in student loan payments if she would have just known about the PSLF system. So now, what are some ways you can even reduce that even further? Looking at I mentioned Mary and John both have access to 403Bs. By going in the traditional 403B side, you can reduce your income, making your payments lower. So let's say Mary was contributing $5,000 a month in her 403B every year for 10 years during those payments. Changed her monthly payment from $395 to $365, so not much of a change. But over those 10 years, possibly saved $4,000. But the biggest part is she would have saved $50,000 in retirement for a later date, which she wouldn't have been able to do if she would have been, making that $3,400 payment on the standard 10-year and not doing anything with PSLF and not contributing to her 403B. All right. I just had a case the other day. We were talking about the difference between should she be pursuing PSLF as a teacher, should she not? We kind of, discussed the differences, and after making the calculations, it made sense for her to pursue PSLF. She thought it was a good idea. She didn't have much income at the time to make her standard 10-year repayment. So that was another reason we went to the IDR plan. So we reduced her payment. We're trying to pursue PSLF, making sure that she recertifies the income. And by doing that, she could possibly save some money on the public service loan forgiveness side. All right, so these are all real ways. I just want to give an example there that, with proper planning, there's ways you can reduce your payment and possibly save money when repaying your student loans. So lastly, just want to say, what should you be doing at this time? I would say, start running some calculations of your own scenario. Start educating yourself, read through articles. There's different calculators on the studentaid.gov website. Talk with the federal student aid office or your loan officer. Unfortunately, during this time, it's wait times. I just called them the other day. It was a 45-minute wait time. Who knows what they're at now? Talk to a trusted professional who can talk to you and walk you through your different options and say, I'm out for you. Then you can decide which option is best for you. But like I said, at the end of the day, it's important to think what's important, or really start thinking about what's important for you. Okay, is it paying less interest over time? Is it lowering your payment? Just make sure you pick a plan, stick with it, and in no time we'll be able to pay off these loans. All right. Lastly, just wanted to open up for questions here at the end here. So appreciate your guys' time. Hopefully this was educational and helpful.